Many beginners ask the same question: when is the best time to buy Bitcoin? The honest answer is that nobody knows perfectly. Bitcoin's price can move up and down very quickly. Trying to guess the perfect bottom or the perfect entry point is extremely difficult. That is why many people use a strategy called dollar cost averaging, or DCA. Dollar cost averaging means buying a fixed amount over time instead of investing everything at once. For example, someone might buy a small amount of Bitcoin every week or every month. The idea is not to perfectly time the market. The idea is to build a position gradually. When the price is higher, your fixed amount buys less Bitcoin. When the price is lower, your fixed amount buys more Bitcoin. Over time, this can smooth out the impact of short-term price movements. DCA is popular with beginners because it is simple. It reduces emotional decision making. It helps people avoid panic buying during hype and panic selling during fear. It also encourages a long term mindset. Instead of constantly asking, is today the perfect day? You follow a consistent plan. Now it is important to be clear: DCA does not remove risk. Bitcoin is volatile, its price can still go down, and no strategy guarantees profit. But DCA can help reduce the pressure of trying to make one perfect decision. It can be useful for people who believe in Bitcoin long term and want a more disciplined way to accumulate. The key is to only use money you can afford to risk and to understand what you are buying. Education should come before strategy. So, what is dollar cost averaging in Bitcoin? A simple answer is this: dollar cost averaging means buying Bitcoin in smaller fixed amounts over time instead of trying to time the market perfectly. It is a simple strategy that can help beginners stay consistent, reduce emotion, and think longer term. But like everything in Bitcoin, it should be done with understanding and responsibility.